Hi friends, so I'm connecting today for discussing the financial management case scenarios. That is the ICI MCQ case scenarios which are coming. Your exams are there in few days, in another few days. So plan was to quickly discuss all the MCQ case scenarios which ICI has released till now, starting from May 24 RTP till your Jan 25 RTPs, MTPs, and whatever exams MCQ, that is your September 24 exam MCQ is also discussed. Now, as you are aware, your paper has 15 marks of MCQ. In that, what will happen in financial management is there will be a 10-mark single question. This will have 5 into 2 and 2 plus 2 plus 1, 5 marks, 3 separate questions. There can be from any chapter. There will not be from a single chapter. And a 10-mark question will be from a single chapter or combination of 2, 3 chapters, but it will be a single case scenario. So one case scenario comes for 10 marks and 2 marks, 2 marks, separate question comes and a 1 mark question come. Now what my plan is, though I'm going to discuss all the question, but I'm going to talk about certain smart techniques which you should be aware while solving the MCQ part. You will see if you are aware of these smart techniques, then you are in a position to quickly solve all the problems. A problem which will take maybe 15 minutes can get over in 5 minutes also if you are aware of these smarter ways. Or a problem which looks very difficult for you to do, you're still able to solve it because you're able to apply these smarter techniques, and that will 100% save time in exam. Now whichever question I discuss, you should ideally pause the video at that time, read the full question, whatever time you want to take, 5 minutes, 2 minutes, 1 minute, because I'm not going to give you time to read the question. You take your time, I'll start explaining the question and start solving it. But before I start explaining, you take your time to read the question. You can pause the video whenever I start discussing a question. So this is my initial point which I want to say. I'm going to start with this compilation which has variety of questions. I'm going to first start with the question number. I'll tell why I'm following a different order. You'll understand because I want to explain those techniques which I'm talking about. I'm going to start with question 26. Question 26, page 14. Question 26, page 14. This question came in September 24 exams. I will start reading the question. You can pause and read it for your understanding. RS Limited. Okay, before we read a question, we should first read the requirements of the question. Why should I read the requirements? When I read the requirements, I'll be very clear what ICI is expecting from us in the case scenario. So my mind will be tuned to look at that data. Now, the requirements of the question is discounted cash inflow after tax. That is your cash flow calculation. NPV is asked, discounted payback is asked, profit before tax has been asked, and cash inflow. So here it is cash inflow after tax, and in the top it is discounted cash inflow after tax. So one place they've asked only cash inflow, in another place they've asked for discounted cash inflow. This is for year 1, year 2, and year 3 discounted cash inflow. Here NPV discounted payback, okay, and profit before tax of year 2, year 3, and year 4. This is 1, 2, and 3. This is 2, 3, and 4. Again 1, 2, and 3. I keep saying this to my students whenever a question asks multiple things, whenever a question asks multiple things, and the options do not have anything in common. For example, here first year 149, or 136, or 154, or 145. Four options you have. Moment you calculate first year, you need not calculate second year and third year. You will have the same answer. So I'll do calculation only for year 1. Only for year 1, automatically year 2 and year 3 will come. This is the smarter technique I'm talking about. Whenever a question is asking multiple things, don't try to get into all the calculation. Just get 1 year calculation, balance 2 year. I'll not even do first year. Listen, why? Because question is asking PBT for 2, 3, and 4. So what I will do is I'll do the year 2 calculation. Year 2 calculation, PBT I get and CFAT I get. I'll answer part 1 of the question. part 4 of the question, part 5 of the question, as well as the discounted payback, So calculating second year cash flow can answer question 1, question 4, question 5, as well as question 3. Why question 3? Because the payback is between 2 years and 3 years here. 2.74, 2 point. So first 3 years payback will be achieved. Only thing which will be pending is NPV, for which you will have to do the detailed calculation, which, let's use in an exam scenario. You are in a hurry. You have to rush through the solution. First, what we will do, we will just do second year cash flow calculation. That answers question 1, question 4, question 5, question 3. With one data point, I'll get 8 marks in exam. NPV part, if time is short, I'll randomly choose something and proceed ahead. Time is available, I'll do detailed calculation. So detailed calculation which I'm going to do now is only for the purpose of NPV calculation only. So this is the smart technique I'm talking about. Whenever a question asks multiple items like this, I'll keep talking in multiple questions. There are many problems like that where ICI asks 2 or 3 questions in a question number 1 or in a question 2 in a single MCQ. Here, first requirement is year 1, year 2 and year 3 discounted cash inflow. Third requirement is discounted payback. Fourth requirement is PBT of 2, 3 and 4. Just doing second year calculation will automatically give me 3 and 4, and automatically I'll also get question 5 answer. You will understand this. I'll just do second year calculation, answer question 1, question 4, question 5, question 3. NPV we will do detailed calculation. See, my objective here is not really to explain full concepts. My plan here is to give you those smarter ways of answering so that you are able to save time in exam and make use of it. Now let's read the question. Question says, RS Limited is manufacturing and selling soft drinks in India. Production process involves one important process which increases the shelf life of the soft drink. Machine used is an old one. Wastage is happening. Basic background. Production manager has approached for purchasing an automated machine which will drastically reduce the wastage due to the breakage. Again, basic background. This is the important data. Sales information is there. So with the introduction of automated machine, additional sales and related cost over the next 5 years. So this is my step 2 inflow. Sales into the selling price, less variable cost, sales into, that is unit sold, into the VC per unit, fixed cost. So I have sales, I have variable cost, I have fixed cost. Cost of acquisition is 5 lakh. Residual life is 50,000. Depreciation under SLM method. So 5 lakh minus 50,000 divided by 5 years. I'll get to know the depreciation part. Also, there are cost savings. Any saving in cost is an inflow for the purpose of capital budgeting, is inflow. Now in case somebody says no, I am not having grip on the concept, that is where the concept book will come into picture. Whatever I tell is covered in 80 pages in my concept book. So if I go to page 45, which is my investment decision chapter, I'll give link of this concept book also to you guys. But if you read the concept book properly, understand it, then automatically you will have clarity. Revenue increase or cost reduction will have the same treatment in calculating cash flow. So when I calculate cash flow, revenue increases, inflow. Cost reduces, also technically taken as inflow. Machine which is being used as zero written down value. If sold today, this is inflow. If I sell this, it has zero written down value. 10,000 is the sale value. There will be a capital gain. But then it says ignore capital gain taxes. According to me, this question, 4 subparts will take you exactly 3-4 minutes. Balance one part NPV may take another 6-7 minutes. So, but yes, it is a very good problem. What I will do is I will first do only the year 2 calculation. To explain you how smarter I answer it, and then I discuss the entire solution. That's more of a formality. So working note 1, computation of cash flows, computation of cash flows of year 2, of year 2, only year 2 calculation we are doing. Balance years I will quickly discuss later. Particulars, amount, particulars and amount. Why year 2? First part is asking 1, 2 and 3. Then I think the fourth part is asking 2, 3 and 4. And the last part is again asking, I can do year 2 or year 3, any of the year, any of the year. Revenues, revenues, year 2 revenues, 25,000 units into 30 rupees, 25,000 units into 30 rupees, less variable cost, less variable cost, 25,000 units into 20 rupees, 25,000 units into 20 rupees, less fixed cost, less fixed cost. Fixed cost is given in the question, which is 30,000 rupees, fixed selling and distribution cost, 30,000, less depreciation, depreciation, which we have already calculated. Depreciation computed by us is 5 lakh minus 50,000 divided by 5 years. 5 lakh minus 50,000 divided by 5 years, 90,000. Add cost saving. Cost saving is inflow. Cost saving is inflow of money. Cost saving is always inflow of money. Savings and cost. Savings and cost due to reduction of breakages. 15,000. I get profit before tax. Profit before tax. There's nothing for you to note down. You understand the concepts, then you solve separately. Then you solve separately. Profit before tax, 1,45,000, less tax at 30%. Tax at 30%. Profit after tax. Profit after tax. Add depreciation. Add depreciation. Cash inflow after tax. Cash inflow after tax. Cash inflow after tax. And the question has also asked for discounted cash inflow. So I'll do the discounting of that. Try to answer those 3 MCQs first, and then I see the entire question, because NPV is asked. If NPV was not asked, this problem gets over with this calculation itself. PVF of year 2. PVF of year 2 is 1 divided by 1.1, again divided by 1.1. We normally have PVF 3 decimal. PVF of year 2, 1 divided by 1.1, again 1.1. And finally, discounted cash inflow after tax. Discounted cash inflow after tax. I've just done second year calculation. I've not done proper analysis. Only year 2 I have done. Now see here. What is the discounted cash inflow after tax for year 1, year 2, year 3? Year 2 only I have done, which is 158, 179. This no, this no, this no, this is correct. So year 1 will be 145, 440. Year 2 will be 158, 179. Year 3 will be 251, 585. What is the use of this? This will give me discounted payback. This will give me discounted payback. First year 145, 440. Second year 158, 179. Third year 251, 585. I'll come to discounted payback. What is the profit before tax of year 2? Year 2 is 145, which is option B, 145. Others I'm not bothered. I'm not even looking at year 3, year 4 numbers. 145 has to be 350, has to be 311, has to be 350, has to be 311. What is the cash inflow after tax of year 1, year 2, year 3? Year 2, 191,500. Year 2 is 191,500. First option no, second option no, third option yes, fourth option no. That's all. With a small calculation, I've already secured 6 marks. I've already secured 6 marks in exam by just doing year 2 calculation, by just doing year 2. In case year 2 number had same answers in two or more option, then you have to do one more year calculation. Otherwise with this I'm kind of done. I have got three subparts of the question with just doing second year calculation, Now I will do discounted payback. For discounted payback, it is year discounted cash flow, cumulative discounted cash flow. Year discounted cash flow, I'm not doing any calculation, I'm just picking from the options which are there. Year discounted cash flow, cumulative discounted cash flow. I am in this video, I'm telling you some smarter ways of answering it. Year 0, year 1, year 2, year 3. Year 1 is 145 440 from this option. 145 440 from the first question. Year 158 179, and third year 251 585, 251 585. First year, second year, and third year. We have done these numbers. Year 0, my initial outflow is 5 lakh for purchase of machine and 10,000 on sale of old machine. No capital gain and all, because ignore capital gain taxes. Ignore capital gain taxes. Year 0 outflow is 4 lakh 90,000. How you do discounted payback? By calculating cumulative discounted cash flow. Cumulative values will be negative initially, it will become positive. Moment it becomes positive, you attain the payback. Moment it becomes positive, you attain the payback. So negative 490, negative 490 plus 145, negative 344 plus 158, negative 186 plus 251. Beyond this I'm not bothered, because payback is going to be between. Look at the options, look at the option. It says this is smarter working: 2.74, 2.87, 2.38, 2.48. So between 2 and 3, between 2 and 3, discounted payback is equal to, just a minute, discounted payback is equal to second year plus I have to recover another 186 on 251. I have to recover another 186 on 251. Another 186 on 251, which is 0.74, which is 0.742 plus 0.74, 2.74 years. In case I was not explaining this question to you, I was not explaining and just solving it on my own, I would have taken exactly 3 4 minutes. That's all. In 3 4 minutes, four questions are answered. 2.74 years. NPV, obviously, I need to do all the calculation, which anyway I have already discussed. I have analyzed year 2. Same way you will do year 1 calculation, year 3 calculation, year 4 calculation, year 5 calculation, and then calculate NPV. Now you may be asking, where are we saving time? I am saving time in case I am in a hurry. In a smart move, I will answer question 1, question 3, question 4, question 5. That's my saving of time. That's my saving of time. NPV, randomly I answer and proceed ahead. Randomly I answer and proceed ahead. In case I still have time, I'll do proper calculation. I will do proper calculation and then try to get to the answer. Otherwise, I just answer it like this. So you see the detailed calculation: capital expenditure, salvage value. I get 490 initial outflow. I showed you calculation for year 2. Similarly, you can do year 1, year 3, year 4, year 5, and then you sell your machine, get salvage value of 50,000, and club these cash flows and calculate NPV. Club this cash flows and calculate NPV. Would NPV, is there any short way? No, in this question I don't find any short way of doing it. I will have to go through yearly calculation, but my objective was very clear. I wanted to teach you this smarter way whenever multiple requirements come in question. Is this only applicable to this problem which I'm discussing? No. I'll now show you another question where it was extremely difficult question, because it ended up asking so many things and became little difficult for students to tackle. But if you follow the technique I said, You need not even know that whatever that question when I discuss, you'll understand. I hope this is done. You can take your time, pause the video, solve it. So 26 is done. I am trying again, I'm explaining. We are working at smarter ways of answering MCQs. Let me then take you to another question which was very difficult for students because of one adjustment. It was only because of one adjustment. I'll come to that question. Yeah, I will come to question 34. I'll come to 34. It looked like an extremely tougher question. It looked like an extremely tougher question in certain requirements. But in the end, then I get to know that I need not do all those calculation. So printed material will have all my analysis. In discussion, smarter way. In discussion, we're going to do the smarter way. As I said for the first question, pause, go through the question fully, then unpause, and then start my explanation. I'll first read out the requirements. Calculate the cost of equity under both method. Now I don't know what both method they're talking about, but we'll see. They're asking about both method. Then overall cost of equity, cost of debt, cost of debt. Calculate WACC and purchase consideration and present value of purchase consideration. Five requirements. Five requirements. Here see cost of equity under both the method. If I know one method, I will be in a position to estimate the answer under the other method. I'll be able to estimate. And when I read the question, you'll understand method one, which the question talks about, is very tricky. Tricky means time consuming. Method two is very simple. So I'll do method two, get the answer for method two. Method one becomes balancing figure. Method one becomes balancing figure. Let's see this now. KBL has completed 35 years of operations in India. Many subsidiary associate companies in more than 100 countries. Business include home, personal care, foods, beverages, industrial, agriculture, other product. One of the largest producer of soap and detergents in India. Company has grown organically as well as through acquisition. Over the years, company has built a diverse portfolio of powerful brands, some being household name. Basic background. It is planning to acquire one of its competitor named Prestige Limited. I'm going to acquire a competitor company, Prestige Limited, which will enhance my growth. Consideration will be 1.5x. Consideration will be 1.5x of the average market capitalization. What is market capitalization? Is market value of the equity. Market value of the equity, that is number of shares into market price. Into market, I'm acquiring another company, I'm going to pay 1.5 times of the market capitalization. Prestige Limited has 1,30,000, 1,30,000, which are traded at an average market price of 45. So market capitalization is, I'm just reading out. As I read out, I write 1,30,000 into 45 into 45, and I am planning to pay 1.5 times of that. I'm planning to pay 1.5 times. Consideration will be paid equally in 5 years, where the first installment is to be paid immediately. When you pay equally over 5 years, technically you are not giving the full amount. Reason is time value of money. Reason is time value of money. I'm going to give equal amount over the 5 years. You'll understand the calculation. Cost of capital is 15%. In order to make this acquisition, because I have to acquire this company, I am going to raise funds through debt and equity in the ratio of 30 is to 70. Debt 30, equity 70. Company requests cost of capital estimates for evaluating its acquisition and performance. KBL share price has grown from 150 to 301 in the last 5 years. 150 to 301 in the last 5 years, and it will continue to grow at the same rate. It will continue to grow at the same rate. It pays dividend regularly. Company has recently paid a dividend of 8. Recently is D0. Recently paid a dividend of 8. For calculating equity, for calculation of equity, an average of 52-week high price in the last 5 years is to be considered. That is for KE calculation, D1 by P naught plus growth rate. P naught, they're saying please take average of the 5 years. I'm not going to do all this calculation. You'll understand as I proceed. Average of the last 5 years. How will I calculate growth? 150 has become 301 in 5 years. 150 has become 301 in 5 years. I will have to guess my rate. How is guessing the rate? Listen, 150, if I do into 1.1 into 1 point in the calculator, 150 into 1.1 into 1.1 into 1.1 into 1.1 into 1.1 for 5 years. For 5 years, you get 241. I need to get 301. Maybe I'll do 12. I'll do 12. I get 264. Maybe I try 14. I try 14. This is trial and error. This is trial and error. Or you have to do IRR approach. 150, 10% I added for 5 years. I got 150 and 1.1 5 times, not working out. 1.12, 12%, 12% not working out. I want to get to T not one, maybe 14% to 88, maybe 15%. Very time consuming exercise, unnecessary. Yeah, 15 is right. 15 is right. 150 is becoming 301. 150 is becoming 301 in the last 5 years. This calculation which I did is not needed. You will understand. The company also wishes to calculate equity using CAPM. Best CAPM is RF plus beta into RM minus RF. Method 2 answer will come. Method 1 is balancing figure. Method 1 is balancing figure. So I am going to do cost of equity. I'm going to do cost of equity using which formula? Using the CAPM formula. CAPM formula is RF plus beta into RM minus RF. So KE, method 2. Method 2. I'm discussing the method 2. This is what smarter techniques helps you. Cost of equity under method 2. Method 2, which is your CAPM, RF plus beta into RM minus RF. Method 1, can I do? Yes, you can do. Growth, you have to do that calculation, trial and error I said. Calculate the growth, add 8 plus the growth rate. Denominator, 5 years average. Denominator is 5 years average plus the growth rate, plus the growth rate. I'll directly get the answer, but yes, in my printed material, you have the detailed explanation. I've also already explained it, but I'm saying that calculation is not needed. Student in an exam situation will get stuck with this. But if he thinks smartly, he will understand this is not needed. This is not needed. So RF plus beta into RM minus RF. RF is 8%. It says long-term government bond is 8%. Risk premium means RM minus RF. Return of market means RM. Risk premium of market means RM minus RF. RM minus RF plus 0.78. 0.78 into 11 into 11. 8 plus 8.58. 16.58%. Now you'll understand what I was trying to explain. 16.58%. 16.58%. I go here. 16.58 is there in option C. So very clear. Method 1 will be 18.65. Method 1 will be 18.65. I'm not doing calculation. I don't see a need for it. I don't see a need for doing the calculation. I don't see a need for doing the calculation. 18.65 and the other one is 16.58. Now they're saying overall cost of equity. For that, first formula has a weight of 0.6. Second formula obviously will have a weight of 0.4. 0.6, that is cost of equity has two different formula. First formula said 18.65. Second formula said 16.58. 16.58. First formula we will do into 0.6. Second formula we will do into 0.4 and I'll get a overall cost of equity. So overall cost of equity is equal to 18.65 into 0.6 plus 16.58 into 0.4 into 16.4, 16.58 into zero point 0.4, 17.82. This gives me more confidence that what I did is right. 17.82%. 17.82%. I did not even do the calculation of that D1 by P naught plus G, because growth calculation is a time consuming. Then cost of debt, if the intrinsic value, what is intrinsic value? Is the real worth of the debenture is 9740. Let's understand this. KBL will issue debentures with face value of 10,500, with face value of 10,500, which is to be amortized equally over the life of 7 years. Equally over the life of 7 years. Amortized equally means you will repay equal amount over the next 7 years. Company considers effective interest rate applicable to a AAA rated company with a markup of 200 basis point as its coupon rate, with 200 basis point as its coupon rate. So coupon rate is going to be 7.5 plus 2, 9.5, 7.5 plus 2, 9.5. Again, for this, some smartness, if a student is aware, will get an answer faster, else you will end up taking a lot of time. 7.5 plus 2 is 9.5. 7.5 plus 2 is 9.5. Now what will I do? Listen, this concept, I'm showing it in my concept book again because I'm not sure many students may not remember this concept. That is why I have to show this in my concept book. Value of a bond and relationship. If interest rate of a bond is equal to investors expectation, you will issue it at par value. If you pay more than what an investor wants, it will be issued at a premium. And if you pay less than what is wanted by an investor, it will quote a discount. This is a concept which I have explained in the concept book as part of my regular classes or in my revision videos also. So interest rate equal to investor expectation, greater than investor expectation, less. In this question, bond will be at discount. Why discount? Face value 10,500. Intrinsic value, that is the issue price, is going to be 9740. 9740. So in this problem, the interest rate 9.5 will be lesser than what an investor wants. Will be lesser. What an investor wants is called cost of debt. What an investor wants is called cost of debt. 9.5 is going to be lesser than what an investor wants. So how do I get it? Very simple. The only two possible answers, 15% or 12%. 15% or 12%. How do you calculate intrinsic value? Discount the cash flow. I will discount maybe at 15%. If 15% doesn't give me 9740, I'll do 12%. One of the two is answer. Again, I'm repeating, only one of the two. 9.5 can't be, 7.5 can't be. 9.5 can't be and 7.5 can't be. This is what I'm talking about. Smarter ways of doing problem. Always work with smarter ways of doing question. So I will do year cash flow PVF at 15%, DCF PVF at 15% and DCF. I discount if I get 9740. If I get 9740, answer is 15%. What is intrinsic values? Present value of future cash flows of the bond. Present value of future cash flows of the bond. Future cash flows of the bond discounted at investors required rate. Investors required rate can be 15 or 12. 15 or 12. So what will happen? Year 1, 2, 3, 4, 5, 6, 7. Every year I'll be paying 1500 principal. 1500 principal. 10,500 equally over 7 years. Equally over 7 years. Interest rate of the bond is 7.5 plus another 2. 7.5 plus another 2, which is 9.5. 7.5 plus another 2, which is 9.5, which is 9.5. 5. So what will happen? First year on 10,500, I'll pay 9.5%. On 10,500, I'll pay 9.5%. Next year, I've already repaid 1,500. I've already repaid 1,500. So I'll pay on 10,500 minus 1,500 minus 1,500 into 9.5% into 9.5%. Next year, another minus 1,500. Next year, another minus 1,500 in the principal, another minus 1,500, another minus 1,500, another minus 1,500. This is what the bond will pay. 997 997 plus 1,500. I'm going to discount this at 15%. If I get 9740, answer is over. If I don't get, I will show in Excel in 12%, but answer will be 12. Then answer will be 12. 15% is 1 divided by 1.15 equal to in the calculator, and then you'll keep pressing equal to. You'll keep pressing equal to. DCF is cash flow into the PVF. Be able to do it faster in Excel. That's okay. I'm not getting 9740. So answer has to be 12. Answer. Why not the other answer? Because I gave you that relationship. So this is smarter techniques. So what I'll do now in class, I'm showing you. So here I'm showing you in 12%. At 12%, I'm getting 9739, which is 9740, which is 9740. Answer is 12%. Answer is 12%. So some of the calculations can happen very fast. Some will take time. Next, WACC. What is WACC? Cost of equity into, because it says somewhere some weights between debt and equity. I'm going to do debt 30%, equity 70%. Debt 30%, equity 70%. Debt 30%, equity 70%. So WACC's debt is 12 into 0.3, equities 17.82 into 0.7. 12 into 0.3, 30% for debt, 70% for equity, 70% for equity. So WACC is equal to 12% into 0.3 plus 17.82% into 0.7. 16.07%. I'm not doing the again purchase consideration calculation. I'll directly copy paste. 16.07 into 87 lakh 75,000. 87 lakh 75,000. What is present values? You're not going to pay 87.75 immediately. Immediately you'll pay 1/5 at the end of first year, at the end of second year, at the end of third year, at the end of fourth year, and I have to discount that. I have to discount that. That is this calculation. Year 0, year 1, year 2, year 3, year 4, discount, you get 66,58,470. You get 66,58,470. From an answer point of view, it is 66,58,997. That's the closer answer. Take it. That's rounding off part which would have happened. That's the best thing. MCQs, even rounding off part is handled. So I have explained you two questions where I've used my smarter approaches to answer question faster and avoid. See, this calculation you have to do. This is a very lengthy calculation which I was talking about. See here. Uh, Average of 5 years price, denominator, growth, I tried 14%, then I tried 15%. When I tried 15%, I get NPVs 0.40. So 15% is the IRR. 15% is the IRR, which I had even got it in the shorter approaches, and then I use it in the formula and then get to the answer. So this is a longer calculation, easier, smarter calculations, just doing method 2, just doing method 2. I hope this is helpful, these techniques. Now I'll discuss the balance set of question, but I just hope that you are able to appreciate these smarter ways of doing the question whenever multiple requirements come, whenever there's something called as elimination route. I'll now discuss about even elimination route. What is elimination route? I'll show it with an MCQ. An elimination route question I'll explain. We are done with question 34. I'll discuss an elimination route question. A small MCQ it is. We're going to discuss elimination route in this question. Question 16, leverages. Question 16, leverages. EBIT 4 lakh, EBT 3 lakh, sales 16 lakh. Which of the following is are correct? First is financial leverage is 1.33. Let's look at FL equal to EBIT by EBT. EBIT by EBT. FL, that's the formula. 4 lakh divided by 3 lakh, 1.33. First option is right. From the choices, this is eliminated because one is not there in the answer there. This is called elimination route. This is called elimination route. I have removed one option. I'm not got to the answer, but I've removed one option. I've removed one option. Interest coverage. Interest coverage formula is EBIT by interest. EBIT is 4 lakh. Interest is 4 minus 3. The gap between EBIT and EBT 1 lakh. 4 times. Point number 2 is incorrect. Point number 2 is incorrect. This is 2 can't be right. 2 can't be right. Right answer is 1 and 3 only. Right. I'm not even doing the operating margin calculation. I'm not doing operating margin calculation, but answer is 1 and 3 only. This is called elimination route. I eliminated option D, then I eliminated option A and option B. I eliminated option A and option B. Only possible answer is option C. This is called elimination. This is an elimination technique. I hope these are very useful. These smarter ways is what you need to do. Let's do few more questions. I may not have every question that smarter technique can be used, but wherever it is possible, please try to use it. Now, ratio analysis, I start from the question 1. Velocity of stock is 3 months. What is velocity of stock is? Stock holding period. Stock holding period is 3 months. Annual sales is 6 lakh. GP margin is 20%. Your stock is calculated based on COGS. Stock is calculated based on COGS. Opening stock is given. They're asking for closing stock. They're asking for closing stock. So sales is 6 lakh. COGS. GP is 20%. GP is 20%. COGS will be 80%. COGS will be 80%, which is 4 lakh 80. 4 lakh 80. And stock is 4 lakh 80 into 3 by 12. Average stock. Average stock is equal to COGS into 3 by 12. Am I teaching anything new concept? No. If you are aware of my concept book, you will go to the place where these ratios have been discussed. Turnover ratio. Turnover ratio, sales by relevant item. Relevant item can be total asset, fixed asset, current asset. For inventory turnover ratio, formula is COGS. Formula is COGS. So inventory turnover ratio is COGS divided by average stock. COGS divided by average stock. Inverse of inventory turnover ratios, average collection period. Inverse of, which is 365 by debtors turnover ratio, 365 by inventory turnover ratio, 365 by creditors turnover ratio. That formula is what we are using here. That formula is what is used here. So into 3 by 12, 1 lakh 20. I break it as opening, closing. Opening is 90,000. Closing, I have to write something. And average is 120. So 90, closing is 150. Closing is 150. Average is 120. Average is 120. Very simple, subtle answer. 90,000, 1,50,000. This is a very good question. Total assets, current liability of Vitrag Limited are 50 lakhs and 10 lakhs respectively. 50 lakhs and 10 lakhs respectively. ROC is 15%. ROC formula is I write it here. ROC formula is EBIT by capital employed. Then measure of business operating risk. This goes to leverages chapter. Business risk means operating leverage and financial risk means financial leverage. So business operating risk means operating leverage is 3.5. Operating leverage is 3.5 and PV ratio 70. Calculate sales. Calculate sales. So I do calculation like this: sales less variable cost. PV ratio is given. They want us to calculate sales contribution less fixed cost EBIT. Let's fixed cost EBIT. EBIT is equal to 15% into capital employed. EBIT is equal to 15%. Reverse. EBIT is equal to 15% into capital employed. What is capital employed? Total assets minus current. It is fixed assets plus current asset minus current liability. Fixed asset plus current asset minus current liability. So capital employed is 50 minus 10, 40. 50 minus 10, 40. EBIT is 40 lakhs into EBIT is 40 lakhs into 15%. 40 lakhs into 15%. EBIT is 6 lakh. Operating leverage, business risk. Operating leverage is contribution divided by EBIT. Contribution divided by EBIT. 3.5 is equal to contribution divided by 6 lakh. Contribution is equal to 21 lakhs. And question has said PV ratio is 70%. So this is 70. Variable cost is 30. Sales is 100. Sales is 100. 100, 30 and 70 reverse working divided by 70%. 30 lakh is the sales figure. 30 lakh is the sales figure. Using multiple ratios. I've used multiple ratios here. You need to know what is capital employed. You need to know what is ROC. You also need to know what is operating risk. Excellent question. These are the questions I'm really happy with ICI testing it in MCQ form. Answer is 30 lakh rupees. Answer is 30 lakh rupees. Next, you can keep pausing, try it, and then see the video. Opening stock is 250, closing stock is 375, sales is 13 lakh, GP is 25, accounts payable. Okay, now it is on payable. Payable means I need raw material purchased. I need raw material purchased for which are purchases. I need purchases. Here, listen, I have sales, GP. Sales and GP will give me COGS. So, right, sales is equal to 13 lakhs. COGS is equal to GP is 25%. GP is 25%. 75% of sales. 75% of sales. 75% of sales. And COGS is equal to opening stock plus purchases minus closing stock. COGS is equal to all this we learn at multiple places. You would have learned it in your 11th, 12th also. All this COGS is equal to opening stock plus purchases minus closing stock. 9,75,000 is equal to 2,50,000 plus purchases minus 370. At any place you need more explanation, pause video or play it at a lesser speed, because my objective here is different students have different needs. Some of them want to quickly cover it, some of them want to understand in depth. You can see in the way some students can play it at 1.5x and all. Purchases is equal to 975 plus 375 plus 250. Purchases is this figure. So I get, sorry, not plus 250, minus 250, sorry, minus 250. And creditors turnover ratio. Creditors turnover ratio is equal to purchases by average payables, purchases by average payables 11 lakh by 80,000. Again, an excellent question. Test multiple concepts. Test multiple concepts. 11 lakh divided by 80,000. 13.75. 13.75. Okay, next is on DuPont model. Now, challenges student is not aware of what is DuPont model. I can't help it. I'll anyway show the formula of DuPont model so that you get a lot of comfort in solving my concept book, going through my concept book. DuPont framework said the formula is this: net profit margin into asset turnover into equity multiplier. That is the ROE formula. Net profit margin, asset turnover, equity multiplier. Net profit is net profit by sales. Sales get cancelled. Asset get cancelled, and in the end, it's net profit by equity. Here, ROE is equal to net profit margin, asset turnover, equity multiplier. Net profit margin is given 12.5, asset turnover 1.5, equity multiplier is not given directly. The formula for equity multiplier is asset divided by equity. Asset divided by equity. 7 lakh 20 divided by 4 lakh 50. And this will give you the answer: 12.5 into 1.5 into 7 lakh 20,000, 4 lakh 50,000, 30%. 30%. This takes care of, I think, ratio analysis question. Yeah, ratio analysis questions are done with this. We have covered ratio analysis questions till this. Different chapters. Well, I have segregated them chapter wise, and in the end, multiple chapters together comes at one places. Okay, now I move to question 5. This is on cost of capital. A company has issued bonds with a face value of 1 lakh, annual coupon rate of 8%. Bonds are trading at 95% of their face value. Approximate cost of debt. Life information is not there. It's an irredeemable bond. Irredeemable bond. Formula for irredeemable bond is interest or interest after tax. They have said anyway before tax. So interest divided by net proceeds. What is net proceeds? Is issue price minus flotation cost in case you're going to make an issue, or current market price, So interest here is 8% of 1 lakh 8,000, and current market price. I'm not making an issue. Current market price is 95% of face value. So 8,000 by 95,000. 8,000 divided by 95,000. 8.42%. 8.42%. Assume KE 11, KD 8, KO 10. What is debt equity ratio of the company? The weights are not given. One option is, you can say weight of equity is X, weight of debt is 1 minus X, 1 minus X, and then try to get the weights. I'm going to do a smarter way. KO is nothing but 11 into whatever weights they have given. 2 plus 8 into 3. 11 into 2 plus 8 into 3 whole divided by 5. 11 into 2 plus 8 into 3. If I get 10, that is the right answer. If I don't get that, then I'll try 3 is to 2. Don't get, try 1 is to 2. Don't get, the final answer is 2 is to 1, whichever. 11 into 2 is 22 plus 8 into 3, 24, 46 by 5. No, this answer will not work. Then 11 into 3, 8 into 2 divided by 5 will not work. Again, it will not work. 11 into 3 plus 8 into 2 divided by 5 will not work. 11 into 1, 8 into 2 divided by 1 plus 2. Divided by 1 plus 2 will get 9%. Right answer is 11 into 2. Last option, 11 into 2 plus 8 into 1 plus 8 into 1. You can do x, 1 minus x, and do all the calculation. Final answer is to 2. Okay, sorry. They wanted debt equity ratio. Sorry, my mistake. They've asked for debt equity ratio. I said 11 into 2. So I should do the other way around. 8 into 2 plus 11 into 3. Sorry about it. 8 into 2. That is debt into the weight of debt. equity into the weight of equity. 8 into 2. The first one is debt, the second one is equity. So answer is 1 is to 2. Doesn't really matter. Concept is same. Let's come to 7. This is a comprehensive case scenario based question. As I said, please first go through the question. You can pause the video and go through. I'll look at the requirements and then read the question. First is cost of equity, second is cost of debt, third is cost of preference, fourth is WACC, and fifth is market price calculation. Five requirements: cost of equity, cost of debt, cost of preference, WACC, and price calculation. I don't think we can do any short approaches and all here. So question number 5, nothing of question is needed. Everything is there here itself. I can answer using this. But okay, let's now read the question. MNP is a multinational company having its operations spread mostly in India, neighboring countries of India. Promoters believed that capital structure must be kept flexible, balanced. Proper mix should always be between debt and equity. Such mix of debt and equity should be reviewed from time to time, keeping in mind the changing situation of India and the global scenario. Capital structure of MNP Limited: debentures, preference, equity share. Following is the additional information provided by MNP relating to the above mentioned capital structure. 100 per debenture, redeemable at par, 2%. Moment flotation cost comes, it is an indication that an organization can make a new issue. 10 years of maturity, market price is 105. 100 preference share redeemable at par, 3% flotation, 10-year maturity, preference 106, all that is given. Then some explanation on why market value weights are better than book value weights. So I will first calculate cost of debt, cost of equity, cost of preference, and I do WACC 1, 2, 3, 4. All the things will get over. Cost of debt, it's a redeemable debt. It is a redeemable debt. So cost of debt calculation is, for a redeemable debt, cost of debt is interest after tax plus average other cost divided by average funds employed. What is interest after taxes? Interest into 1 minus tax rate. Interest into 1 minus tax rate. As far as debenture is concerned, 100 per debenture, 9% debenture, 9% debenture. So 9 rupees is the interest. 9 into 65%. 9 into 65%. 9 into 65%. Average other cost. Average other cost is redeemable value minus net proceeds. Average other cost is redeemable value minus net proceeds by balance life. This is the extra cost. This can be negative also rarely. What is redeemable value? Redeemable at par 100. Net proceeds is issue price minus flotation cost. Issue price minus flotation cost. What price the issue will happen? Mostly the current market price. Sometimes I can take par value and all, but mostly the current market price. Issue price minus the flotation cost. Issue price minus the flotation cost. So net proceeds is 105 minus 2%. 103.1 divided, this will be negative, this will turn out to be negative, divided by 10 years. Average funds is redeemable value plus net proceeds by 2. In case I have to change, because the net proceeds issue price can also be taken as par value. If I have to change the assumption, I'll look at in the choices. In case I don't get my choice, then I change the assumption. So the calculation is 9 into 65% minus 3.1 by 10. This is my denominator. Numerator is average, and cost of debt is 5.45. If I have 5.45, it is done. Cost of debt will be 5.45. I have 5.48. So ideally that can be the answer. Else if I've done some calculation error, we don't know. Just give me a minute. 105 minus, if at all I've done a calculation error there, minus the flotation cost was 2%. Oh, sorry, it's 102.9. Sorry, this is 102.9. 102.9. Sorry about it. This is the benefit of MCQs. The benefit of MCQs is all this. In a hurry, if you make mistakes, all that will get corrected. Here it is, will be 3.1 only, and this is 202.9. 202.9. 100 plus 102.9. 5.46. I'm getting now 5.46. 100 plus 102.9. 100 plus 102.9. Sorry. Let me do the calculation itself. 100 minus 102.9, 2.9 by 10. Ha, I've finally got the right answer, 5.48. Sorry about the calculation errors. I don't have a calculator with me as of now, so in a hurry I've done some mistakes. 5.48, 5.48% cost of debt is done, which is what the option is suggesting. Option is suggesting 5.48%. Then the second one, cost of preference, same formula, AP is equal to preference dividend average other cost by average funds employed. I'll not rush through here. Preference dividend is 100 per preference share, 11 rupees, no after tax. Redeemable value is redeemable at par, 100. Net proceeds is 106 minus 3%. Let me do proper calculations. 106 minus 3%, 102.82 divided by life 10 years, whole divided by 100 plus 102 divided by 2. All this MCQs, I assume you have already done preparation and doing it. This is not for first time preparation and all. 11 minus 0.282. 11 minus 0.282. Denominator is 101.41. Hope no calculation errors. 10.57%. 10.57%. No calculation errors. 10.57%. Cost of equity is the simplest of the lot. K is equal to D1 by P naught minus F plus growth rate. D1 is next year expected dividend 2. P naught minus F 24 minus 4. Growth is 0.05. So 0.10 plus 0.05, 15%. What is WACC? Using market values, I'll have to take a weighted average of this, for which our format used to be like this. Source, cost, weight, product. Source, cost, weight, and product. We had three forms of capital: debt, preference, equity. Debt, preference, and equity. Debt, the cost is 5.48%. Preference, the cost is 10.57%. Equity, the cost is 15%. Weight is market value. What is market value? Debenture 2,75,000. One debenture is 100 rupee and the market value is 105. Market value is 105. So 275 divide by 100 into 105 into 105. Preference 225 again divide by 100 into 106 into 106. 225 divide by 100 into 106. Equity 5 lakh divided by 10 into 24. That's all. You will do multiplication, put a total of this sum of product divide by sum of weights. Sum of product divide by sum of weights, 12.8%. 12.8%. And last is nothing to do with the original requirement of the question. K is now 10%. So 10%, 0.10 is equal to 2 divided by P naught plus 0.05, no flotation cost and all here. 0.05 goes to the other side. 0.05 is equal to 2 by P naught. P naught is equal to 2 divided by 0.05. It will turn out to be 40 per share. It will turn out to be 40 per share. Again, very simple kind of question. These type of questions keep coming in exam. I'll move to question 8. Again, a very slightly tricky, but using smart work, you will see one major calculation I'm not going to do. One important calculation, a time consuming calculation. I am not going to do that calculation in question 8 also. That is all smart work, all smart work. Let's first look at the requirements. Cost of equity is asked. Issue price of debenture is asked. Then cost of debenture is asked. Cost of preference is asked. Approximation method, and overall cost of marginal capital. This WACC part, I'm not going to do the calculation. You will understand why we are not doing calculation of WACC and how can we answer without doing calculation. Without doing calculation, how are we going to answer? Because the question did not give proper choices here. Let's read the problem now. Tiago Limited is an all equity company engaged in manufacturing of batteries. Surge in demand. Company was established 5 years ago. Capital of 10 lakh. Raised funds by IPO. Now the capital is 1 crore. Now the capital is 1 crore. Company also has undistributed reserves of 60 lakh. 1 crores capital. Reserves is 60 lakh. Company is following constant dividend payout policy of 40% of earnings. Constant dividend payout policy of 40%. So dividend paid is 40%, retention is 60%. Retention is 60%. ROE is 20. What is the use of this? Growth is equal to ROE into retention ratio. As I read, I am explaining the concepts. ROE into retention ratio, 20 into 60%. Growth is 12%. Growth is 12%. Current EPS means today's EPS is 20. Today, the dividend will be 40% of earning. Today, the dividend will be 40. Let me close the KE part. K is equal to D1 by P naught plus growth rate. D1 is 20 rupees, which is your EPS, into 40% and add the growth. So 20 into 40% is 8 rupees. Add 12% growth. 8.96. What is prices? Price is equal to EPS into P multiple. EPS is 20. P multiple given in the question is 15. 300. Growth is 12. Growth is 12. How did I get 12 growth? I had already done 20 into 60%. So my final answer now is 0.0299 plus 0.12 1499 or 14.99%. 1499 or 14.99 percentage is the answer. 14.99 percentage is the answer for part 1 of the question. Which of the following is the issue price? Issue price of a debenture is present value of future interest and principal. Future interest and principal. Let's look at this. Retain earnings 10%, P multiple 15. Company wants to expand its capital base by raising additional funds way of debt, preference and equity. I need an additional fund of 1 crore 20. Today I have fund of 1 crore 60. How 1 crore 60? 1 crore is equity capital, 60 lakh is reserves and surplus, and another 120. So put together 2 crore 80. Put together 2 crore 80. In that 2 crore 80, owned funds to borrowed fund. In that 2 crore 80, owned fund is 4, borrowed fund is 1. So borrowing is 2 crore 80 into 1 by 5. 2 crore 80. All that calculation will not be needed in the end, you will understand. 2 crore 80 into 1 by 5. And capital gearing. Okay, you need to know what is capital gearing ratio is. Preference capital plus debenture by equity. preference capital plus debenture by equity's capital gearing ratio, that is of the 2 crore 80, equity is one portion, preference and debenture, equity is one portion, preference and debentures put together, preference and debentures put together is point 4. All that calculation will not be needed. Existing debt markets are under pressure due to ongoing RBI action on NPA, due to ongoing RBI action on NPAs of the commercial bank, due to challenges in raising the debt fund. Company will have to offer 100 face value at an yield. Yield means investor need. Investor need is 9.5. Investor need is 9.5, but I am giving an interest of how much? 8%. You are paying 8. Investor wants 9.5. You are paying 8. Investor wants 9.5. Investor wants 9.5. In this case, bond will be issued at discount. Bond will be issued at discount. How do I calculate? Year, cash flow, PVF, DCF. You will be paying 8. Discount rate will be 9.5. Discount rate will be 9.5. This is due to challenges in raising the debt. The company will have to offer 100 face value debenture at an attractive yield of 9.5% and a coupon rate of 8% to the investor. Issue expenses will amount to 4% of the proceeds. Life of the debenture they have not told till now. That's there in the next para. Preference share will have a face value of 1000, dividend rate of 10%, issued at a premium of 5, redeemed at a premium of 10 after 10 years. At the same time, debenture will also be redeemed. So debenture has a life of 10 years. Debenture has a life of 10 years. Last para is of no use, nothing to do with solving the question. Nothing to do with solving the question. Now I will do issue price of debenture. How do you calculate issue price of debentures? In year, cash flow, PVF at 9.5% and DCF. PVF at 9.5% and DCF. 10-year debenture. The cash flow is going to be 8 rupees you will pay, 108, and discount at 9.5. Discount at 9.5. Discount at 9.5. You can even use annuity factor. A different answer. At an attractive yield of, let's just read the question again in case I've made a mistake, and a coupon rate of, coupon rate of 8%. Issue expenses. So we will pay 8 rupees. 9.5. What happened? Okay, sorry. I put 10.95. 1 point. Yeah. 90.64. 90.64. 9.5. Discount rate was wrong. Discount rate was wrong. Sorry. 90.64. Closest is 90.58. This will be the answer as per the ICI material. Our answer, rounding of differences, 90.58. Then cost of debenture using approximation method. Cost of debenture is equal to interest after tax, average other cost, average funds employed. I'm paying 8%, 8 rupees. 8 rupees I pay. Tax rate given in the question is 27%. So 8 into 1 minus tax rate. 8 into 1 minus tax rate. Redeemable value minus net proceeds. Redeemable value minus net proceeds. Redeemable value minus net proceeds. Redeemable value is 100. Net proceeds is 90.58. Issue price minus flotation cost. Issue price minus flotation cost. Issue price minus flotation cost. 90.58 into 96%. 86.96. 10 years, 100 plus 86.96 by 2. Now onwards, I'll quickly only do discussion. So explanation is done. Explanation is done, and the answer turns out to be 7.64. Answer turns out to be 7.64. Preference, same formula. Then I'll say that shortcut. What is preference? Is preference dividend plus average other cost divided by average funds employed. Divided by average funds employed. Preference dividend here is I am paying a dividend of 1000 into 10% 100, redeemable value minus net proceeds by balance life. Redeemable value is 10% premium 1100, will be issued at a premium of 5%. So redeemable value minus net proceeds divided by 10 years, whole divided by 1100, 1050 by 2, whole divided by 1100, 1050 by 2. So you get an answer of 9.77. You get an answer of 9.77. Now I will explain that shortcut approach here. 9.77, 7.64. Questioners asked for weighted cost of marginal. Marginal means the additional money which we are going to raise, that 1 crore 20 lakh. I'm not doing any of this. See, final answer will be average of 14, 7 and 9. Where average of 14, 7 and 9 means it has to be in between this. Now ICI, what they did is they gave 17, which is not possible, beyond 14. Highest was 14.99. Not possible. Not possible. Exact obvious answer 10.52. Obvious answer is 10.52. Why should I do all the calculation? Why should I do all the calculation? Obvious answer is 10.52. Weighted average. Though I can do all the calculations. See, 2 crore 80 is the overall money. Then that 1/5 is debt. Zero point 0.4 if you do. That is, you see the calculation here. 2 crore 80. 0.4 is capital gearing ratio. So fixed capital is 40 lakh. Equity is, that is 80 lakh, and equity is 2 crore. In this 80 lakh, debt is 56, balance is preference, and equity extra. And I do calculation all that 10.52, but without doing any computation, I can directly get answer of 10.52%. Hope you're able to understand the smarter ways of doing the question. Here also, I could have directly answered it without doing such a detailed calculation, because WMCC is a weighted average of 14.99, 7.64 and 9.77, has to be in between the three, has to be in between the three, which in this case will work out to be 10.52, which in this case will work out to be 10.52. Okay. Mm, Nothing much will be there. Ranu and Co has issued 10% debenture of face value 100 for 10 lakh. Debenture is sold at 5% discount. Flotation cost redeemable at a premium. Cost of debenture if the tax rate is 30%. So cost of debenture is equal to interest after tax, average other cost, average funds employed. Interest is 10% debenture, so 10 rupees into 1 minus tax 7. Redeemable value minus net proceeds. Redeemable values at a premium of 10%, 110. Net proceeds is issue price minus flotation cost. 100 rupee debenture, no 10 lakh and all. 100 rupee debenture. 5% discount means 95. Flotation cost 10 rupees. So issue price minus flotation cost 85 divided by 10 years, whole divided by 110 plus 85 by 2. Answer and all I can see it in the printed material. I am not bothered much about that. 7 plus 110 minus 85. 110 minus 85. Redeemable value is 110. 85 is issue price minus flotation cost. Issue price minus flotation cost. So 85 divided by 10 years. Divided by 10 years. Whole divided by 110 plus 85 by 2. Okay, let me do the answer also. You will get comfort then only. 7 plus 5, 12. 110 minus 85. And good part is, in case you make like I made mistakes, if you make mistakes, it gets rectified then and there. That's the beauty of MCQ. I get 12 point. Again I made a, sorry, mistake is 7 plus 110 minus 85 divide by 10, divide by 10, I did divide by 5 in a hurry, divide by 5. So 9.5 divided by 97.5, 9.5 divided by 97.5, I get 9.74%, 9.74%. Mistakes I can also make, you can also make. So that's the beauty. The MCQs are going to ensure that you are error proof, you are at error proof. This is a very good question. Capital structure of KPS Limited includes 5 lakh equity shares of 10 each, market price of equity share cum dividend. The term cum dividend means dividend is included in this price. For all our formula, we need X dividend price. For the formula, we need X dividend price. So from 75, I will have to remove the dividend. So price is not 75. Dividend is 6, which will be paid over the next 3 days. So price is only 69. For KE calculation, you have to use X dividend price because that's the real price of the share. That's the real price of the share. So K is equal to D1 by P naught plus growth rate. D1 by P naught plus growth rate. It says I paid 6. The company has a history of consistent dividend growth. Its predicted dividend for the next year is 7.59. Dividend for the next year is 7.59. Dividend for the next year is 7.59. P naught 75 minus 6, 69. What does growth is? 6 rupees becoming 7.59. So growth is 7.59 minus 6. In 1 year this happened, divided by 6, divided by 6. Let me do the calculation in Excel. 7.59 minus 6 divided by 6 into 100 to X percent, 26.5%. 26.5 plus 0.265. 0.265. Answer is 7.5 by 69 plus 0.265. 7.59 by 69 plus 0.265, 0.375, 0.375, 37.5%. 37.5%. Again, the important concept is you will have to use the X dividend price. You'll have to use the X dividend price. Why X dividend and all? If you need explanation, it is there in the concept book. Concept book has whatever points I am telling you now. X interest versus cum interest. For computing, we should always use X interest value. X interest means for debt, and like cum interest, cum dividend value. For equity, you have to use the X dividend value. For preference, you have to use the X dividend value, and for debenture, you'll have to use the X interest value. X interest value. Okay. With this, chapter 4, the cost of capital questions are over. Now I'll be moving to the capital structure questions. We are done till cost of capital, ratio analysis done. Cost of capital questions are done. Lot of questions I've done it in a smarter way. Some question I have to do a detailed calculation. Okay, let's move to now questions on capital structure. It's a lengthy question. So let's look at the requirement. EPS under plan 1, plan 2, plan 3, and indifference point between 1 and 2, and indifference point between 1 and 3. I don't think any shortcuts will work here because they have not asked for multiple requirements. If there are multiple requirements within a question, we can do shortcut and all. Here we used to have 3 steps. First step, you will have to find out the alternative. Second step, you will calculate interest, preference dividend, and number of equity shares for the alternative, and then calculate EPS. First, whatever EBIT they have given. Second, assume EBIT as X and then do it. First para I am not reading. There's nothing there in the question. Second para also nothing there. I'll just come to this. Company needs 3 crore 12 lakh 50,000. 3 crore 12 lakh 50,000 for the investment in technology and improvement of manufacturing facility. 3 option. Issue 31 lakh 25,000 equity shares at 10 per share. Issue 15 62 500 equity shares at 10 per share, and 156 250 debentures of 100 denomination bearing a 8% 9% rate of interest, and 15 62 500 equity shares and 156 250 100 per share bearing a 10% rate of dividend. And the EBIT expected is 37 lakh 50,000. EBIT expected is 37 lakh 50,000. Based on the above fact, management wants us to answer the following questions. So EPS under plan 1, plan 2, and plan 3, and EBIT, EBIT, and EPS indifference point. Uh, I'll do whatever steps I normally do. So we need to calculate interest, preference dividend, and number of equity shares for the various option. Particulars and 1 and 2 and plan 3. Number of equity shares. Number of equity shares. First plan has 31 lakh 25,000 equity shares. Second plan has 1562 500 equity shares. And third plan also has 1562 500 equity shares. Then requirement is uh, first part is done. Then the second requirement is interest calculation and one no interest expense. In plan 2, 156 250 debenture, 156 50 debenture, 9 rupees interest, 9 rupees interest, 156 250 debenture into 9 rupees, no interest. And preference dividend. First plan no, second plan no. Third plan we have a preference dividend of again 156 250 10 rupees dividend, 10 rupees dividend, 156 250 into 10. This is the basic data. We have to calculate EPS. There, EBIT number given in the question is 3750. That question 1, 2, and 3 will get answered. 1, 2, and 3 will get answered. Particulars and 1 and 2 and plan 3. EBIT, EBIT 3750 less interest 0, 0, and 0, 14, 06, 250 and 0. EBT, EBT less tax, tax at 40%, tax at 40%, tax at 40%, EAT, EAT less difference dividend, difference dividend, we get EAES. All this discussion is very, very simple. And you divide by number of equity share, which is calculated in the above table. Number of equity shares, I get EPS. Number of equity shares is 3125, 1562, 1562. EPS 0.72, 0.9, and 0.44. 0.72, 0.9, and 0.44. So first one is 0.72, 0.9, third one is 0.44. Then they're asking indifference point between plan 1 and plan 2 and plan 1 and plan 3. For indifference point approaches, same table, this will be called X. Same table, I'm going to repeat again. X, X, X. It will be called as X. Bit will be X. EBT will be X. X minus 1406 50. X will be 40%. So first one is X, X minus 1406 250, and X again 0.4x, 0.4 into X minus 1406 50 and 0.4x, EAT 0.6x, 0.6x, that is 1 X minus 1406 into 1, 1 minus 0.4 is 0.6, and 1406 50 into 0.6 is 843750, 843750, 0.6x, difference dividend, these numbers, and 0.6x, 0.6x minus 843750, and 0.6x minus 1562 500. You will have to assume it as x. Number of shares remains same. EPS is 0.6x by 31 lakh 25,000. 0.6x minus 843 750, 1562 500. 0.6x minus, these are the numbers. What is indifference point is you have to equate EPS, equate 1 and 2. If you want to equate, if you want indifference point between 1 and 2, you have to equate this, that is 0.6x by, I'm just doing one of them, 31 lakh 25,000. 0.6x minus 843 750, 1562 500. Mathematically this is one time, two times, it goes to the other side. 0.6x 1.2x minus 843 750 into 2, 1687 500. 0.6x is equal to, and x is equal to 1687 500. 28 12 500 is the answer. Just a checkpoint. Checkpoint is, it's right here, 28 12 500, 28 12 500, both are giving same EPS. 28 12 500, 20. In Excel I can do all this. 28 12. In fact, if I want, I can take first number 28 12 500, 28 12 500 in this and calculate. If I get same answer, that's the answer. The second one, either you equate it or 36, try 45, try 28, try 52. One of them you'll get an answer. I'm not discussing the other one. You'll have to equate that. 28 12 500. Other one is 5208 333. No shortcuts are going to work in this question. Next, Abhi Limited is an all equity financed company. It is considering replacing all equity finance company. It is considering replacing 275 lakh equity share with debenture. Current market value is 1750. Cost of capital 20. Future EBIT is going to remain constant. Entire earning, corporate tax rate. Moment tax comes into picture, approach with the taxes. What does approach with taxes is? Value, see, as of now it is an unlevered firm. What is unlevered? It does not have any borrowing as of now. As of now, the company does not have any borrowing. It is called unlevered company. It is called unlevered company. Moment you bring borrowing, value of levered companies, unlevered company plus amount of debt into tax rate, plus amount of debt into tax rate. We have our format. Start with EBIT less interest, BT less tax, KT, leave a line KD, KE, O, leave a line value of debt, value of equity, and value of firm. As of now, it is unlevered and it will become levered. It will become levered. This is the format I use in every question. Most of the problems which I do is format driven, unlevered and levered. As of now, originally, just considering replacing, okay, current values 1750, equity 1750, firm 1750, no debt. Both are same, equity and this. AD not applicable. And it says cost of capital is 20%. Cost of capital is 20%. Equity will also be 20. Capital will also be 20. Now our KO has a formula. KO is bit into 1 minus tax by value. 20% is equal to EBIT. Tax rate is 3%, 0.7 to 1750. If I do cross multiplication, I'll get the EBIT answer, which is 1750 into 20% divided by 0.7. 500, no interest. Tax is 30%. And I get EAT 350. EAT 350. This is the current situation. Moment it becomes levered, value of levered firm is unlevered. I'm going to add a debt of 275. I'm going to add a debt of 70. In fact, very good question. This revises most of the concepts also. 275. This plus 275 into tax rate. 275 into tax rate, equity balancing figure continues to be 500. Interest now you have to pay 275 lakh interest you have to pay. On that the interest is given. It says it is considering replacing 275 equity share with 15% debenture. With 15% debenture. So 275 into 15%. EBT, tax, EAT, cost of equity is EAT by amount of equity. EAT by amount of equity. And cost of capital is EBIT into 1 minus tax rate by value of firm. Requirement of the question is what will be the new cost of equity? What will be the new cost of equity? 20.62%. I could have answered this even without doing the calculation had I known this. See, originally the cost of capital is 20%, our cost of equity is 20. If you borrow more under approach, cost of equity will go up. So if 20 has to go up, answer is only 20.62. 19 can't be, 17 can't be, 10 can't be. When you borrow more, equity, the cost of equity will only go up. I did so many calculations. I could have directly written 20.62. I could have directly written 20.62 because cost of equity will only go up in case you borrow more according to approach. Capital structure 30 lakhs. Earnings available to equity shareholder 30 lakh. Cost of equity is 15%. Debt outstanding 150. What is value of firm? So first is equity. Equity is equal to EAT by cost of equity. EAT by cost of equity. Where does all this come? In this chapter, just have all the formulae here at one place. These are the formulae. Format for solving capital structure theory questions without tax. Cost of debt, cost of equity, cost of capital, interest by value of debt, EBT by value of equity, EBIT by value of firm. And if you have tax, you have to do into 1 minus tax rate. So EAT by cost of equity 200. Value of firm is value of equity plus value of debt. Value of equity plus value of debt 200 plus 150, 350 lakh. A company is considering changing its capital structure by increasing its debt ratio. What is debt ratio? Is debt divided by debt plus equity. What will be the impact on cost of equity? What will be the impact on cost of equity assuming all other factors remain constant? I just now answered that here also. In case you borrow more, risk increases, cost of equity will increase. Risk increases, cost of equity will increase. Risk increases, cost of equity will increase. Okay, indifference point calculation and the EPS at that indifference point. I will have to take it as X and do. I'll do it, but it's the same question which we did earlier. So I use this format and one and plan two. X, EBIT is X and X. Interest option 1 it's not there. In option 2 10% debenture, 10,000 debenture, 100 rupees face value, so 10,000 into 10 rupees interest 1 lakh. X minus 1 lakh. Tax rate is 35%. 0.35x, 0.35 into x minus 1 lakh. This is 0.65x, 0.65x minus 65,000, minus 65,000. Difference dividend not there. In this case, 5,000 into 100 rupees dividend. EAES 0.65x, 0.65x minus 1 lakh, 25,000, 65 and another 60 is subtraction. Number of equity share 25,000, 10,000, and this is 0.65x by 25,000 and 0.65x minus 1 lakh 25,000 divided by 10,000. Have to equate both. Have to equate both. 0.65x 25,000, 0.65x minus 125, 10,000. You'll have to do 0.65 into 2.5. 1.625x, 1 lakh 25 into 2.5 minus 312,500, net 312,500 is equal to 0.975x. X is equal to 312,500 divided by 0.975. 0.975, 320,513. Okay, I have now two choices, 320,513. The shortcut approach will not work. 320 can be either of the two. So I have to substitute 320,513 and calculate EPS in one of them. That is, if I substitute 320,513, 320,513, one I substitute it and I get access, sorry, subtraction 8.33. So 320,513 and 8.33 and 8.33. So with this capital structure discussion also got over, we had decent set of questions. One on your the financial, sorry, the indifference point testing was there, as well some questions on the capital structure theories as well. I'll be moving to the next chapter, which is on leverages discussion. Okay, now question on leverages. 16 is already done. This is where I'd explain here also that concept which I said, that is the elimination route. Margin of safety is profit divided by PV ratio. Does it change in case PV ratio changes? Yes, it has to change. So 1 is right, which means I eliminate 2 and 3. The 2 and 3 option can't be right. 2 and 3 option can't be right because 1 is right. Fixed cost changes. If fixed cost change, my profit will change, and automatically margin of fixed cost change, BP changes. Fixed cost changes, BP changes. So 2 is also right. And if the overall sales change, if the overall, so all the three changes, my margin of safety is going to be affected. Will affect by all the three. Degree of operating leverage 2 times, financial leverage 3 times. If the sales increase by 5%, sales and EPS is linked with combined leverage, which is 2 into 3. So combined leverage is 6 times, and if sales increase by 5%, EPS will increase by 5% into 6 times, 5% into 6 times. X has actual sales of 20 lakh, break even sales of 15 lakh. Total risk is combined leverage. Total risk is combined leverage. Calculate the impact on EPS. EBIT and EPS. EBIT and EPS is linked with financial leverage. EBIT and EPS is linked with financial leverage. Here I have combined leverage 6.5, break even sales 15 lakh, actual sales 20 lakh, margin of safety is 20 minus 15, 5. So MOS is 5 lakh on 20 lakh, 0.25. Various formula you will have to be aware. MOS is 5 by 20. Operating leverage is 1 by MOS, 1 by 0.25, 4. Operating leverage 4. Total risk, total leverage, that is the combined leverage is 6.5. So financial leverage is OL into FL is equal to CL. 4 into FL is equal to 6.5. Financial leverage is 6.5 divided by 4. 6.5, 1.625. If EBIT is affected by 12, EPS will be affected by 12 into 1.625, 19.5%. Excellent question. Very, very good question tested by ICI. 19.5%. Operating leverage is asked. It's similar to the earlier one. Break even is 6 lakh. Margin of safety is 4 lakh. Margin of safety is 4 lakh. So margin of safety is 0.4. 4 lakh by 10 lakh. 0.4. 4 lakh by 10 lakh. Operating leverage is 1 divided by MOS. 1 divided by MOS. 1 divided by 0.4. 2.5. 2.5. If EBIT increase by 6%, net profit increases by 6.9, sales increase by 6. Financial leverage formula is percentage increase in EPS, otherwise called as profit, net profit. EPS is otherwise net profit, divided by percentage increase in EBIT. 6.9 by 6, 1.15. 6.9 by 6, 1.15. Favorable financial leverage. What is favorable financial leverage? Is again, it's everything is there in my concept book. Again, I'm repeating. Financial leverage, favorable, non-favorable is you have to compare return on capital employed with interest rate on debt. Now, what is return on capital employed? 75 lakh minus variable cost contribution 33 minus fixed cost 6 lakh. 27 lakh is EBIT. 27. So ROCE or ROI is EBIT 27 lakh. Capital employed is debt plus equity. Capital employed is debt plus equity 45 plus 55. ROC is 27%. You can do after tax also. Tax rate is not there. Interest rate on the debt is 9%. So does it have favorable? Yes, because I'm earning 27% and interest rate is only 9%. ROI is less than interest rate. No, it is not less than. ROI is greater than. ROI is equal to no. ROI is greater than interest on loan funds and it has favorable financial leverage. It has favorable financial leverage. A company has sales of 6 lakh, variable cost 240, fixed cost 270, financial leverage, wants to double its EBIT. Double is EBIT. Sales and EBIT is linked with operating leverage. Sales and EBIT. So first I have to calculate operating leverage. Operating leverage is equal to contribution by EBIT. Contribution is 6 lakh minus 240, 360. EBIT is 360 minus 270, 90,000. 4 times. Operating leverage is 4 times. So operating leverage is equal to change in EBIT by change in sales. Change in EBIT by change in sales. 4 is equal to change in EBIT. Double means 100% change. 4 is equal to 100 by change in sales. Change in sales is 25%. Double means 100% increase. Double is 100% increase. 25% is the answer. So with this, leverages questions are discussed. I'm done with the leverages question. I'll now move to investment decision questions. First question, payback period calculation. Following is the data on a capital project being evaluated by the management of Aman Limited. Annual cost saving 1 lakh 80. life is 5 years, internal rate of return is 10%, salvage value PVAF. Let's first get what is the outflow of the project because they have given IRR. IRR is the rate of return at which NPV of the project is 0. So if I do that, year cash flow PVF at 10% ECF, this will give me the outflow of the project. Year 0 and 5 same number. Year 0 I don't know the outflow because they have given cost saving, they have not given the outflow. Outflow is what we are calculating using IRR. 1,80,000. 5 years annuity factor given in the question is 3.79. NPV 0, this will be 680 200. The first year the outflow is 680 to 200. Outflow is 680 to 200. Payback calculation. You have the same amount every year. Shortcut for payback is outflow divided by the inflow, or you do year cash flow, cumulative cash flow. But if it's the same amount, I use a shortcut 680 to 200 divided by 180, 3.79. Same number you will get 3.790 years. 3.790 years. Payback reciprocal. Payback reciprocal is reverse of this formula. Initial outflow by cost saving, reverse cost saving by initial outflow. Requires an initial investment 20,000. Cost saving inflow is 4,000. So 4,000 reverse cost saving is the numerator, 4,000 is the inflow, investment is the denominator, divided by 20,000. 4,000 divided by 20,000, life of 10 years is of no use in this. 4,000 divided by 20,000, 20%. Reverse formula. Reverse formula. 26 I had done earlier, which is where I had started explaining the smarter techniques. 27, I know I get I feel really bad when such a question was added in, I think in some MTP or RTP. The video of this is available in my channel. The video of this question is available in my channel. I will share the link of that also in the description because this question solving itself took me 40-50 minutes. Very lengthy. No shortcut was also working. If some shortcut had worked in this question, I would have been very happy. The question itself runs into 2 pages. The solution will run into I think 3 pages. So it's a very lengthy kind of a question. Lots and lots of calculations are needed. I am not discussing this, but anyway, I have already uploaded a video on this, so you can watch that video. I don't expect ICI to test such an extremely tough question, and in case it comes, that's really somewhere a bad luck which is there. uh, in case if such a tough question comes, my suggestion is answer it in the end. If some guess estimate you can do, try to randomly pick answers in the end, everything in the end, not at the beginning, because it will end up taking a lot of time. It'll end up taking a lot of time. So now I move to dividend decision. Dividend decision is your Walters model, Gordon's model, all that. Cost of capital is 12%. Earnings per share is 20. Payout ratio is 50%, 25%. Company is planning to increase its payout ratio. What will be the effect on the price? What will be the effect on the price if the reinvestment rate is 15%? So let's first get the original answer. Original answer is KE 12, again 12. Expected earnings is 20. Payout ratio, dividend is 5. Growth, growth is uh, 25% payout, 75% retention, 75% retention. And reinvestment rate is ROI. ROI is 15%. Growth is ROI into retention ratio. ROI into retention ratio, 75 into 15% will be 11.25%. Price is D1 divided by KE minus G. KE minus G. D1 divided by KE minus G. 5 divided by 12 minus 11.25 is 0.75. 666 point. Good question. It's a good question. Now they are saying I'm going to increase the payout to 50%. So I'll now pay 20 into 50%, 10 rupees. But if you increase payout, retention goes down, growth will go down. Growth will now be 50%, retention 50% into 15. 7.5, 7.5, and now my price is D1 10 divided by D1 10 divided by K minus G 4.5%. 22, price is going to decrease. This is not a very good decision. This is not a very good decision. Price is going to decrease by 444.45. Price is going to decrease by 444.45. Not a very good decision taken by the company. Under Modigliani and Miller irrelevance theory says there will not be any impact of dividend on the shareholders value. A company has 1 lakh to distribute. If it chooses to retain, you retain or pay, does not matter under Modigliani Miller. What happens to shareholder wealth? Increases? No. Decreases? No. Remains unchanged. Remains unchanged because value depends on earnings. What you earn and investment, and it does not depend on dividend according to the theory. Remains unchanged because value depends on earnings and investment policy. Earnings and investment policy. Now I'm moving to the next chapter, which is on working capital management. Question 30. In let's look at the requirements. Receivables, advance factor will give, cost of factoring, net cost of factoring, effective cost of factoring. So this is a problem on factoring. For factoring we have, again I keep saying, because uh, in case student is clear with the concept book, see here a beautiful format is given, and that format will give you the answer here. So you see this. For factoring, this is the format. Credit sales, collection period, amount of debtors. One requirement of the question. Less receive, less commission, amount eligible to lend, less. What is average level of receivable? How much advance will the factor give? Uh, Annual cost of factoring, total cost, effective cost of factoring. Everything will come from the format. So it says the total sales is 200 lakh, of which 80% is credit sales. 80% is credit sales. What matters is only credit sale. Company has a credit policy of 2 by 40. 2 by 40. What is 2 by 40? Is 2% discount if you pay within 40 days. Otherwise, make the payment in 120 days. Past experience indicates that 50% people will pay in 40 days, and another people balance will pay in 120 days. 50% people pay in 40 days, 50% people pay in 120 days. On an average, receivable is 50% into 40, 50% into 120, 80 days. 80 days is the receivable. Because of escalating cost, the company has decided to do something. Currently the firm spends 2,40,000 to administer its credit sale. These are avoidable. It will charge 2% commission. It will pay an advance of 18% after withholding 10% as reserve. Company also has an option of taking a loan at 15% or a bank finance at 14%. That's another choice I have. That's okay. You are required to answer the following question. Let's put it in that format. I'll put in this format. Credit sales. Look at the question. Credit sales is 200 lakh into 80%. 1 crore 60 lakh. This is just to give you that comfort. Collection period 80 days. Amount of debtor 1 crore 60 into 80 by 360. Question has said 360 days. 1 crore 60 into 80 by 360. 55 lakh 55,000 556. 35 55 556. 35 55 556. 10% is reserve. 10% is reserve minus 3 lakh 55 556. Commission. Commission is 2% of 35 lakh 55,556. 2%. 71 71 triple one. Amount eligible to be lent is 5 3 crore 55 556. 71 triple one. 1 28, 889, 31, 28, 889. That is eligible to be lent. In that, what I lend is after deducting 18% interest. Some companies may not deduct the interest and give the entire amount and recover interest later. It depends on the negotiation skills of the factoring arrangement. So 3128 on this 18% interest, 80 days, 80 days, net will be lending 30 lakh 3,733. 3 lakh. I'll deduct the interest portion. Interest portion is 125, 155. Net amount lent. Net amount lent is 30 lakh. What is effective cost of factoring is this commission which I calculated was for 80 days. Now I have to do the annual calculation. So 71,111 for 80 days. What is it for 360? What is it for 360? So commission will now become 71,111 into 360 by 80. The interest will become 125, 155 into 360 by 80. Together 8 lakh 83 197 I'm getting. 8 lakh 83 197 is 883 200. From there you deduct the benefits. What is the benefit? Bad debt will not be there. And the second, I think you need not pay this 2 lakh 40,000 on administering the receivables. So I will have saving in bad debt, saving in admin cost. I get effective cost, net cost of factoring, and divide by the amount lent. Divide by the amount lent. The reason I'm not solving it fully is I just wanted to explain the approach of solving it. My purpose here in the entire video discussion, I'm just looking at smarter ways of answering a question. This question, I don't find any extra smarter way to solve it. That's why I quickly discussed it and proceeded ahead. Okay, 31 is a very lengthy question. I will, ठीक है, I will, because some requirements I can do it in a little smart way. So we will read the question and then try to answer some requirements in the smarter manner, some requirements lengthier calculation. For 5 requirements of the question: anticipated PBT, which will come from a cost sheet; estimated current assets in the first year of operation, debtors calculated at cost. Net working capital is current assets minus the current liability. Current assets minus the current liability. Annualized cost of two option. I will analyze only one of the two. I'll not analyze both. I will not analyze both because one of them I answer, the second one I'll answer. Second one will automatically come. MPBF and annualized cost. MPBF and annualized cost. Again, I'll calculate one of them. Other one will automatically come. That's the smarter way. That's the smarter. Let's look at this. AR More LLP is the newly established startup dealing in manufacturing of a revolutionized product HDHMR, which is substitute for conventional wood, plywood, economical substitute for the manufacture of furniture, home furnishing. Basic background: cost of setting up the plant would be 5 crore, 1 year to make the unit operational, units to be sold, selling price, raw material cost, labor hours, manufacturing overheads, machine hours, selling and distribution overhead. Being a new product, the firm will give longer credit period of 3 months, stock of raw material 15%, negotiation with creditor, payment period agreed is 1 month, entity will hold finished goods 2 months, all other expenses 1 month in arrear, cash and bank balance 25. I also want to reduce working capital, for which I have two options. One option is reducing the credit period to the customer. If I reduce credit period to the customer, my debtors will go down, but sales is also going down. Sales is also going down. If sales goes down, my profit goes down. Or engaging with the factor, engaging with the factor. I am not going to analyze the factoring part. I'm not going to analyze the factoring part because the question had said two requirements, two options are there. Annualize cost of two options. First option we analyze, second option automatically will come. Then entity is also considering funding a part of working capital by bank loan. Bank has said I will give 75% of net current assets. 75% of net current asset. and rate of interest is 16.5%. In that, there is some 10% to be kept as minimum average balance. I'll explain this. Let's first do a cost sheet. It's a new company. We'll do a detailed cost sheet. In the cost sheet, I will get the profit figure, and then I'll do estimation of working capital. Working note 1, cost sheet of a new company. Cost sheet of a new company. Particulars calculation amount. Cost sheet of a new company. Opening stock of raw material 0. Add purchases less closing stock of raw material consumed. Raw material consumed. I will get the data here. I'm going to sell 3 lakh square meter. I'm going to sell 3 lakh square meter. If I sell 3 lakh square meter, I have to manufacture more than 3 lakh. More than 3 lakh. Why more than 3 lakh? Because the question is talking about stock of raw material as well as stock of FG. It says being a new product in the industry, 3 months credit period, stock of raw material, payment period, finished goods will be 2 months of units to be sold. So 3 lakh into 2 by 12. 3 lakh into 2 by 12 will be my finished goods. So I'll have to indirectly produce 3 lakh 50,000 in the first year. In the first year, because this is a first year. This is a first year. You'll have to produce even for the stock which is going to be there. So 3 lakh 50,000 into 3 lakh 50,000 into this is the consumption into 200 per square meter into 200 per square meter. 200 per square meter, and closing stock is RM consumed into 15%. 15% of consumption. 15% of consumption. Purchases balancing figure is 8 crore 5 lakh. Purchases balancing figure is 8 crore 5 lakhs. 3 lakh 50,000 is the raw material consumed. And labor cost is 3 lakh 50,000 into 50 per hour into 3 hours. 50 per hour into 3 hours. So 150. 150. 150 labor cost, and overheads, manufacturing overheads, again 3 lakh 50,000 into 75 into 2. 75 into some understanding of costing will be critical here. Get cost of production. WIP is not there. This is for 3 crore, 3 lakh 50,000 less. Add opening FG 0 less closing FG. Closing FG is 50,000 units. 50,000 units. So 1750 divided by 3 lakh 50 into 50,000 into 50,000, get cost of goods sold. Cost of goods sold from COGS. Selling and distribution overheads is 250. Selling and distribution overheads is only for units sold. It's always for units sold. 3 lakh into 50. Cost of sales, profit and sales. Sales is 3 lakh into 1000. and profit is 750 lakhs. Profit is 750 lakhs. This is the most important calculation. Profit is 750 lakhs. If I look at the requirements, profit before tax per annum for the first year is 750. First year is 750. I'll do estimation. Do estimation. Particulars calculation amount. Current assets. Items we have already estimated. Stock of raw material already estimated. Stock of raw material was 1 crore 5 lakh. Closing stock 1 crore 5 lakh. Stock of FG 2 crore 50 lakh. Already estimated. Raw material is estimated. FG is estimated. Then, being a new product, I'll have to offer a credit period of 3 months to my customer. Stars. Question clearly said on cost. On cost. Cost means cost of sales. 22 crore 3 lakhs into 3 by 12 into 3 by 12 into 3 by 12 says debtors have to be calculated at cost. Debtors have to be calculated at cost 5 crore 62 lakh 50,000. Being a new product, firm will give 3 months credit period. Stock of raw material. Payment period is 1 month from the date of purchase. Creditors purchase into 1 by 12. Purchase is there in the earlier calculation. Purchase to 1 by 12 into 1 by 12. Creditors is purchase into 1 by 12. Then they have said entity will hold finished goods. All other expenses, everything is 1 month credit. Credit outstanding expenses, all other expenses 1 month. Just wages, manufacturing overheads, selling and distribution overheads, divide by 12, 1 by 12. Wages, manufacturing overheads, selling and distribution overheads, 1 by 12. And cash. Cash is given in the question. Cash is 25 lakhs. Total current asset and working capital is deduct current assets minus the current liability. So question options are 9 crore 42 and net working is 725 41. 725 41. Now they're asking, I want to reduce working capital. Only two things I'm going to analyze. First two options, first option only I will analyze, which is reducing the credit period by a month. If you reduce credit period by a month, benefit is if credit period goes down, my debtor will go down. So what will be the new debtor is I calculated this. Now the new debtor will be this into 2 by 12 into 2 by 12. I am going to save 1 crore 87 lakh. I'm going to save 1 crore 87 lakh 50,000. The problem is if sales go down, profit will also go down. Profit will go down. So benefit is debtors are going down. Disadvantages, the price I pay for this is 7 crore 50 lakh into 5%. 5% profit down. 5% profit down. So net the cost is, give me a minute, sorry. One more calculation, sorry, I didn't. Your cost of sales, write it here. This will now become 95%. This will now become 95%. Profit will become 95%. Sales will also become 95%. Sales will also become 95%. New debtors is new sales into 2 by 12. New sales into 2 by 12. Earlier cost of sales, new cost of sales into 2 by 12. Sales will go down by 5%. So sales went down, cost of sales went down, profit went down. So 2 crore 6 lakh 25,000 is the reduction. Profit went down by 3750. And the cost is 18.18. 18.18 means with that 16.92. That it is 16.92. Maximum permissible bank finance I'll calculate, which is very simple. Question has said you are going to pay 75% of net current asset. 75% of net current asset, which is 75% of your whatever working capital you got. 725, 41.67. So MPBF is equal to 75% of that. MPBF is equal to 75%. Second requirement, I will help you in answering it, but technically I don't need it. What is the second requirement is annualized cost. What is annualized cost is, listen, I am taking a loan at 16.5. So I will take a loan at 16.5, pay interest on 100 rupees if I take a loan of 100. But effectively I can withdraw only 90. Why withdraw 90? Because 10% of loan amount will be held as minimum average balance. So I'll pay 16.5 on a 100 rupee loan, but my effective loan is only 90. Effective loan is only 90. This is called compensating balance. Again, it's there in the concept book. Again, it's there in the concept book. None of the question except for that one very lengthy question which I talked about, everything else is there in my concept book, not even the bigger book. It is there in the concept book itself. 32, it involves working capital management, cost of capital and investment decision. Again, we are going to do some shorter approach, very simple logical approach, and we'll get to the answer. Some requirements smarter approach, some requirements longer calculation. Let's look at the requirements first. Optimum cash balance, gross and net working capital, amount of funds, overall cost of capital, amount of revenue subsidy. So now onwards we are getting into questions. Working capital management chapter is also over. We are getting into question which involves more than one chapter. More than one chapter. 5 requirements. You will see smarter way of answering this here. Let's read the question. Samvar Limited, a leading FMCG company having its current presence in more than 150 tier 1 and 2 cities in India. The stores are operating in the brand name of GoMart, competing with Reliance Fresh, Walmart, Big Bazaar, other chain. Owing to the increase in demand from tier 3 city, it is planning for expansion, opening up additional store which will have variety of FMCG product. CFO and his team estimated that for expansion, we will need 200 lakhs per store. Such funds would be utilized for buying out a space, store, other fixed asset. Central government will give a revenue subsidy of 15% on GP. The subsidy is 15% of our GP which we make if the cost of capital does not exceed 10%. If the cost of capital does not exceed 10%. Apart from the above, all other data, average sales will be 120 lakhs per annum with a GP margin of 18%. With a GP margin of 18%, customer pay through different digital mode and channel, including POS systems, which generally takes around 9, which generally takes approximate 9 days for the funds to be credited. See, you when you buy in a supermarket, you can pay cash or you can pay debit and credit card. That I'll take 9 days to collect. 15% of the customer are using debit and credit card, and installing this will take also a fee of 2%. So in my GP, another 2% will go away for this fees. Whenever we use a debit and credit card, the supermarket has to pay fees. Being an FMCG product, inventory of multiple products need to be kept. Different products have different storage period. Primarily, product are classified into 3 broad category: durable, semi-durable, and perishable. 60% is perishable, 25% is semi-durable, and balance is for durable. What is the use of this? They are saying 10 days, 30 days, and 60 days. So my average holding is perishable 10 into 60%, semi-durable 30 into 25%, and balance durable 60 into the balance 15%. This will give me average inventory holding. All this I'll not do for analysis. When I smarter way, all this is not needed. Supplies will give me 30 days credit. Each store will employ 20 personnel. Monthly average salary is 4 lakh. Companies will pay salary on the first month. First of the next month means it is basically, it indicates that outstanding salary. Baumol model. Excess cash Total disbursement 1.5 lakhs per month with the transaction cost of 20 per transfer. Optimum capital structure, debt equity is 2 is to 1. And the cost of raising debt and equity. If you raise up to 80 lakh, debt is 10%, 12 and a half. The extra, it's very clear. Up to 80 lakh, you can do 10 and 12.5. The extra portion will be 11.5 and 13.5, and then the extra portion, first is optimum cash balance. Optimum cash balance is Baumel's model, square root of 2 into annual demand of money, transaction cost divided by your opportunity cost or interest cost. 2 into annual demand of money, 1.5 lakhs per month. 1.5 lakhs per month, annual demand is 18 lakh. Transaction cost is 20 rupees. Opportunity cost is 12%. 12% is 0.12. This will give me the answer. Square root of 2 into 18 lakh into 20.12. 24,495. So gross and net working capital. For this, you have to calculate debtors, you have to calculate inventory, you have to calculate creditors, you will have to calculate cash, which we have done. None of them I'm going to do. See here, it says gross and net working capital. Gross is 6. Net can't be more than gross. So this option is eliminated. Net can't be more than gross. This is also eliminated because this is a huge gap. 200 lakh can't be the working capital. When you evaluate the question, you will find the sales itself is 120 lakh only. Sales itself is 120 lakh. How can the working capital be 200 lakh on a sales of 120? This option is also eliminated. This option is also eliminated because net is more. So the real answer is this. Gross is 6.67 and net is 5.93. Net is 5.93. This, if you have to do, you have to do such a detailed calculation. 593 995, 593 995, very lengthy calculation. It is a very lengthy calculation. Yes, you can go through this calculation, but as I said, my objective is to help you out in smarter ways. In case this was not possible, I would have done all the calculation. Once required to set up a store, 200 lakh is for all that data given in the question. It said 200 lakh is for you need space, renting out space, all that. And working capital is negative 5.93. So 200 minus 5.93, 194. 194. Then overall cost of capital for raising, for setting up each store is, in this 194, first 80 lakh, 10 and 12.5. Then extra 80 to 150 is, extra 70 lakh is 11.5 and 13.5. And then the balance overall need is 194.06. Overall need is 194.06. So you see, first 80 lakh, 1 is to 2. The debt equity ratio is given in the question. You are going to raise it in the ratio of debt 2 times, equity 1 time. So you see the calculation here. 80 lakh, equity 1 by 3, debt 2 by 3, cost of equity, cost of debt, multiply and write product. Then 80 to 150, extra 70 lakh, 1 by 3, 2 by 3, 150 to 194, extra 44 lakh, extra 44 lakh, 1 by 3, 2 by 3. In the end, I get 9.9%. In the end, I get 9.9%. And the question says, I'll be getting a revenue subsidy. I'll be getting a revenue subsidy, which is 15% of GP, which is 15% of GP in case the cost of debt is less, the cost of project is less than 10%. So I'll get subsidy also. GP into 15%. Broadly, very simple. 33 you can manage on your own, nothing much is there. So 34 I've done. 33 you do it on your own. Just one question I want you to do it on your own, which involves two items. One is your leverages and second is your investment decision. See, the focus of this entire discussion, I have done around 2.5 hours of discussion. Focus was not on discussing these 34 questions. Focus was giving you a smarter approach, so that looking at the choices, you can do your calculation faster and get to the answer. Whenever a detailed question comes, most of the times looking at the options, I'll be able to eliminate few of the choices and ultimate. And MCQ in exam, please ensure you answer all question. Even one question you should not leave it in choice. One question also should not be left in choice. You answer anything. If you don't know, choose one of the options and then proceed ahead. I think this video should be useful to you guys. You can comment in case you need any other help in financial management, or how this video has helped you, or any suggestions for improvement. Thank you, friends.